Let's talk to somebody who's actually has a professional here on this whole thing. David Kudla, he's the founder, he's the chief executive officer, and he's the chief investment strategist. I think that means he's the boss.
It sounds like it.
That's right. Mainstay Capital Management from one of my favorite little towns out there in the Midwest, Troy, Michigan. I've been to Troy, Michigan, cool little town. David, so you get a retail sales number today that's better than expected. You get still a pretty strong labor market. Is this a Fed that has to cut? And if they don't have to cut in November, is that okay?
Good morning, Paul and Nora. I think it's a Fed that will continue to cut. They'll continue to ease because monetary policy is more restrictive than it needs to be. Inflation has come down. I know there's fears that we could see a resurgence of inflation here yet this year into next year. But inflation has come down and is drifting towards target. Certainly it is in Europe. The ECB cut last night. The key here is that when we look at the economy, and I think it's, what's interesting is, do they need to cut for a recession? No. Those that have been calling for a recession for the last 2 years have been dead wrong. And we've kind of mocked this by my phrase, the recession is always 6 months away, that I've actually been saying for 2.5 years now. And yeah, retail sales came in above expectations, 0.4 month over month versus 0.3. We've got strong GDP, Atlanta GDP now forecast above 3%. Labor's hanging in there. And so I always am careful to use the word Goldilocks economy, but we sure, if there's such a thing as a Goldilocks economy, we're sure close to it right now. And the Fed does have the ability to continue to ease, as other central banks are around the world, just because we're in that sweet spot where they can make monetary policy a little less restrictive.
So tell me, David, which economic data is most paramount right now? I know we've always had our eyes on inflation, but it seems as though attention is really shifting toward employment data as being more important right now. What's your outlook on that?
Yeah, Nora, and I agree. It's really, it's this, when we look at employment or labor versus inflation, where are we? And we see inflation drifting down. We think that's becoming a more non-existent problem. We keep getting mixed data on labor. There was some screwy numbers in the back months that had to be revised. But if we want to keep an eye on labor, we want to keep an eye on the consumer, being 2/3 of our economy. So we need labor to stay strong enough, but not too strong, and not get weak enough that they're cutting, for the reasons we don't want, which is the fear of a recession. And we think that the fears of a recession, there's anecdotal data there. What's happening with car loan delinquencies, personal debt, credit card debt. There's that anecdotal data. But when we look at GDP, we look at labor, we look at inflation, we look at retail sales. We've got, when we look at the macro numbers, we've got an economy that keeps chugging along, and correspondingly, a stock market that keeps chugging along. Again, the people that have called for a bear market any time over the last 2 years, they weren't early. They were just wrong, dead wrong. And we're still constructive on stocks. It always looks prudent, right? It always looks prudent or smart to say a recession is right around the corner or a bear market's right around the corner. But it's key. These people that have been saying this for so long, they're dead. They're just been wrong.
So, David, how are you advising your clients now versus maybe this time last year? All that said, we're always concerned about when the next shoe will drop, or, when the first shoe will drop or the next shoe will drop. We are concerned about that. So that's why we're keeping an eye on the data that we're talking about here on, is inflation on a glide path down to the Fed's target? We believe it is. Do we still have, though, a robust economy? Are we headed towards recession? We don't think so. So we continue to be very constructive on the markets. We're overweight equities. We've changed our term structure on our bond holdings somewhat. We were last year, in the first part of this year, on the shortest end of the curve, just capturing yield rather than any kind of interest rate play or anything else, because duration has worked against you. We think there's an opportunity over the next year that duration will help you. You can get that capital appreciation
combined with the yield on your stocks, clip the coupon and enjoy some capital appreciation. But I think my strongest recommendation is, all the naysayers, all the doomsayers, the pundits that are, collapse is imminent. Look, they've been wrong. And so we're very constructive on the markets. We're bullish on the markets near term. We have an election coming that will get out of the way, so that removes some uncertainty. And we're heading into the seasonal period that's strong for stocks from November through April. So, there's a lot of economic seasonality and other factors that are good tailwinds for equities right now.
David, you mentioned the election. You got 19 days, I think, coming up or very close here. What do you tell your clients about it? I mean, is there any way to election-proof a portfolio or not? Don't worry about it.
Well, unfortunately, and not our clients, because we educate our clients about this a lot, every election cycle, don't election-proof it by going to cash. That's the worst mistake that investors make. Because look at this election, like others, how polarizing, between the two candidates. If so-and-so gets elected, we're going to heck in a handbasket. And then same thing for the other candidate. And there's all this concern. The reality of it is the biggest factor for the market is uncertainty. Markets hate uncertainty. Right. That will be determined here in 3 weeks. So the key is don't go to cash, stay invested in the market. And as we see who it looks like what administration will be in office here in a few months, that's where we want to be tactically moving our portfolios to. Worst mistake is to go to cash. And look, this year is a perfect example. We have the best election year through today for the markets that we've had since the 1930s. Yep. That's how good this year is. Yep. It is not the time to go to cash, to wait on the sidelines until you see how it comes out, right? Yep. So it's looking at what do you expect with a candidate that will win, tactically allocating your portfolio for that, and stay invested.
Yep, excellent stuff. As always, David Kudla, he's the founder, chief executive officer, and chief investment strategist at Mainstay Capital Management. And David and his team are ranked in the top 10 on Barron's top 100 independent financial advisors in 2024. So we appreciate getting a few minutes of his time.